have an inverted yield curve. You have an ISM below 50. But the employment picture, I mean, you're really parsing it to say we have an employment problem. The firings continue to get lower. The hirings continue to be over 100,000. So it's kind of worse than it was, but nowhere near enough to cause a broad-based recession.
So it's contained, you think, contained to the industrial economy?
It's absolutely contained. The problem with the industrial economy, when it weakens, it's impossible for us to visualize when does it stop. Is it simply going to soften a little bit more, or do we kind of over-extrapolate that and assume that you're going to get a recession? So I think that investors sit on the sidelines a little bit with respect to the market. You know, I've been super bullish for the last 5-6 years. I just think that investors hate deceleration. This is going to feel a lot like 2015 when we were in this global industrial downturn. The market didn't like it. The second it ended, it took off.
Right. Speaking of being bullish for the last 5 or 6 years, Brian, I don't think your patience is not being tested, is it?
No, it isn't. And the problem with the industrial economy, quite frankly, Carl, relative to the consumer economy, is the consumers are going to spend money regardless. And the industrial base never spent the money that they received in the tax breaks. And I think that's the key component. They sat on their hands during last year's move in terms of earnings and all the cash that they should have spent. They used it on buybacks and paying and increasing their dividends. And I think that's a key feature that I don't think enough people are talking about. You got an almost 45 basis point spread between where 10-year treasuries are yielding and where the market is yielding. I still don't think investors are focused on equity income growth. We're still bullish longer term. We're not being bullish just to be stubborn, Carl. We're being bullish because we still think that dollar-denominated assets are the place to be in rotation back into U.S. stocks, regardless of what happens over the next quarter or so. Because let's face it, the majority of investors, meaning consensus, have already priced in an industrial earnings recession. They've already priced in a Democrat winning the next election, and people are already bearish. I don't think people are poised for a potential upside surprise.
You know, let me just jump on something that Brian said, which is we were never spending these breaks. If you look at the slowdown in corporate spending on infrastructure, that happened way before Donald Trump took office. Yes. And the assumption that we have was everything was fine until we had this trade war, and now the wheels are coming off. But if you look at the trend, this kind of looks like what was in place before. So is this an incremental, headwind? Maybe, but I think that we're way overplaying this as a risk to the market.
Brian, I'd push back on this notion of industrials not putting those tax cut dollars to work. I mean, transportation companies, FedEx, UPS, for example, started plowing more money into their infrastructure. Saw a similar thing happen with aerospace and defense companies. Nonetheless, does this feel like 2016 deja vu to you in terms of the industrial piece of the economy? And if so, what does that mean for how investors should be positioned in the market?
I'll push back on your comment, Morgan, because if you take a look at UPS and FedEx, their CapEx was all about the consumer, and what I said earlier was this economy continues to be all about the consumer in terms of spending money. With respect to aerospace and defense, they always increase CapEx. It's like a utility. They have guaranteed revenue from the United States government, 25 years in a row of increasing dividends, so they're always spending money. You got to be careful on that. But I would say this, is it a replay of 2015, 2016? I think the way the market is playing it, per Jonathan's comment, yeah, we've already pretty much decided we have not seen spending. I'll take it even further. We haven't seen a CapEx cycle in our country since the late 90s. Industrial companies have been sitting on their hands and firing people and buying back stocks. So they've been playing defense for way longer than President Trump's been president of the United States. And so the culture of being so afraid to be wrong, you don't want to be right in terms of any kind of growth needs to change. And the only way that can change is if we have clarity in terms of the trade thing. This is all right now on a near-term basis about trade. We are one tweet away from being up 5% or one tweet away from being down 5%. This is a market that is almost impossible on a near-term basis to predict, and that's why you have to stick longer term and buy good cash flow companies.
So now, Brian, and the two of us have been in agreement. We have something to disagree about. The second you put on these tax incentives a couple of years ago, the market was assuming that 2019 and 2020 would have weaker GDP for one simple reason, that this stuff was going to grandfather off, and and we knew exactly what we were going to get. The fact that the fourth quarter GDP is supposed to come in at 1.9, the market's been predicting that not for a quarter, but for the last year and a half, that we were going to slow not towards a recession, but back towards a weaker trend. Here's the most important story, which is longer term, we're in a weaker growth environment. That's not bad for the single reason that Brian said, which was companies in that environment are returning a ton of capital and doing a great job of that. What makes me more bearish in the near term is that during the period of going from above trend growth back to trend, that deceleration is not investment friendly. And I think the market's going to have a hard time in this transition.